All right, so why don't we get started? So thank you guys very much for joining. Excuse me. I'm going to talk about ETFs today. Oh, I have the chat disabled again. Okay, hold on. But I'm going to talk about ETFs today, which hopefully should be an interesting topic. We'll talk about both finding individual ETFs, and we'll talk about, as soon as I figure out how to work the chat, and we'll talk about building a portfolio with ETFs. And yeah, obviously, we'll spend some time answering any questions that you guys have while I try to figure out how to get the chat working. But first, housekeeping items. Anything you hear today is general advice. I obviously cannot offer personal advice, but as I said, we'll do questions for anyone who has any questions, and we'll see if we also have a chat. I don't remember how I did this last week. It was a bit of a miracle that I was able to figure that out. So I'll do my best here. Give me 1 second. Okay, hopefully the chat works now. So all right, let's dig into this. Oh, we got a chat, so it is working. Good news. So now you can answer each other's questions instead of asking me. So yeah, how to build a portfolio with ETFs. So a little bit of an overview for anyone who did come last week. We spent time talking about an investment strategy. So obviously I'm not going to go over that again today, but if anyone wants a detailed article explaining how to set up an investment strategy, send me an email. So my email is mark.lamonica1@morningstar.com. And now if we want to start using ETFs as either part of our portfolio or only want to invest in ETFs, the first thing we need to do is we need to evaluate individual ETFs to determine if they fit into our strategy. And then we have to look at how an ETF actually fits into a portfolio. So we'll do both of those things today. But remember, any investment you are picking to go into your portfolio, good idea. Thank you for that, Doug. Good idea to make sure that it fits into your strategy, what you're trying to accomplish, your goals. That is the most important thing. And that's why we are all investing. All right, let's get started. So we're going to go through a couple high-level tips for selection of ETFs or selecting ETFs. Anything but what I put on the header of that slide. But we'll go through some high-level ideas, and then we'll go into some examples. So I have 2 different examples that we'll walk through. So the first thing is obviously ETFs are divided up, or not obviously, maybe people don't know this, but there are actively managed ETFs and there are passively managed ETFs. So we'll spend a lot of time on the passively managed ETFs today, but first, a couple of words about an actively managed ETF. Actively managed ETF is really no different in terms of the investment process that the manager will go through than a fund. In fact, a lot of actively managed funds also have actively managed ETFs because it makes it easier for investors to access those ETFs. Now, if you're evaluating an actively managed ETF, there is a different process because obviously there are humans in there that are making decisions about what goes into the portfolio and the timing of all those transactions. And really to evaluate that ETF, you need to evaluate them. Now, that's not the easiest thing in the world to do. But really, there are 3 main pillars that you want to focus on. And this is what our analysts do at Morningstar. Now, they obviously have access to that ETF, actively managed ETF manager, and can spend time speaking to them. So it does make the process a little bit easier. But really what you want to focus on is, number one, who are the people making those decisions? So do they have a track record of doing well? Do they have the education and experience that you think they would have? What is their process for selecting individual securities? Now, this is tricky to get into. Obviously, they will talk at a high level about the process within marketing material. There will be a governing structure around any actively managed fund that has certain rules saying what they can invest in. So that could be everything from a country. They can only invest in Australian shares, for example. Could be some rules around diversification, how a single security can't be above a certain threshold, for example. But then the process that they're using is really how they're picking things that go in there. So I would encourage people to read the fund documents. Obviously, that's not going to give you all the information about how they implement that process, but it is important to understand that. And of course, the price is really important. So the price, of course, we're talking about the fee on that ETF. So actively managed ETFs in most cases charge a higher fee, and you have to decide whether that's worth it or not. So we're not going to spend too much time on that. We're going to focus on ETFs that track indexes. Now, there's kind of three different flavors that this comes in. So there are what we would call, or what I am calling, traditional passive. So a traditional passive ETF. That means they are tracking a broad index. So a broad index is supposed to be representative of whatever you're trying to invest in. So for example, in Australia, if we want exposure to Australian shares, a broad index would be the ASX 200 or the ASX 300. And that's really supposed to represent the market here in Australia. So really, when we're thinking about those, we're thinking about those indexes we look at to see how an overall market is performing. The S&P 500 is a very famous one as well. So there are those traditional passive ETFs that give you that broad exposure. There are thematic ETFs. Now, many of these ETFs will track an index. A lot of the time, this index has been specially created to capture that thematic. So when we talk about thematic ETFs, it could be everything from someone who wants to invest in technology shares, or even narrower than that, they want to invest in what are some of the big ones that are out there? AI, for example. So one of those themes that investors want exposure to. Now, traditionally, those are going to track an index, but we'll get into how those indexes are formed. And then we have factor ETFs. And a factor ETF is really looking at something like dividends, an ETF that's trying to get exposure to high dividends, an ETF that's trying to get exposure to value shares or growth shares, things like that. So different investment factors. And once again, they're often tracking an index. That index will have certain rules, and we're going to want to explore those rules. And that's what we're going to go through today. And so anytime you're doing this, the most important thing to do, and we'll get into this, is look at the criteria that's used for defining that index. Now, that can be everything from a traditional passive to give you an idea of what your exposures are to some of these narrower niche thematic or factor ETFs. One piece of advice I guess I'd have, ignore the name of the ETF and the very high level description and focus on the details. And the reason, of course, is because how an ETF is named and this very high level description of what it's trying to do, those are mostly created by marketers. And they're obviously trying to get you interested in that ETF. But if we want to evaluate ETFs and we want to spend some time figuring out what we want to invest in, we need to focus on those details. And those are some of the examples that we'll go through today. So what specifically we're looking for are, what are the criteria that someone is using to create that index? So what is the criteria of what goes in and out of the ETF? And particularly, we want to look at changing a portfolio. And the reason we want to do that is the changes have ramifications on you. And I'll give a little bit of I'll give you a little bit of an example, but we want to look at those changes. We want to look at the index construction, so that we understand what is happening in that ETF. And then we want to look at the holdings, right? So we see in the real world what's actually happening. Fees are important, but as I said before, we want to think about after-tax returns. And so what you'll see in a lot of these index rules, or a lot of these indexes, are rules around things like rebalancing and portfolio adjustment rules. So remember, anytime you're buying an ETF or a fund, if it is rebalanced, if it's an actively managed fund or ETF and the manager is actively making decisions, or if that index changes, that is going to have an impact on you. So those capital gains that are generated, so if an appreciated security is sold, those capital gains get passed to you. They get passed to you via distribution. So distribution is what the ETF or fund pays you out. That distribution is not just dividends. A lot of people think that's just dividends. It's not. They also distribute capital gains to you because that's a taxable event. So if indexes are frequently rebalanced, if there's frequent adjustments to that index, you will pay taxes on that. So it's important to take that into account when you start thinking about your after-tax returns, which is obviously the most important thing for all of us. And each of our tax situations vary. It varies if it's in super, if it's out of super. So those can be very large tax hits that you're going to take or smaller ones. But either way, it's important to know. So I'll pause for a second and try to answer some of these questions that have come through. And some are somebody's AI assistant is saying something. I'll ignore the AI assistant. So we've got a question from Daniel saying, a lot of the forums groups I am part of get stuck on the ETF itself without looking at the underlying assets as a key part of choosing an ETF or focusing hard on previous returns rather than what the underlying assets will achieve, the amount of overlaps. I see sometimes are staggering. Yeah, so we're going to get into that with portfolio construction. So a lot of people have some interesting views about diversification in terms of ETFs, and they're not really doing that. So that's a really good, that's a good observation, Daniel. Yeah, and another thing, and I was going to bring this up, Daniel's talking about thematic ETFs. So what you have to understand that, there is a business that is creating these ETFs. Obviously, they make more money the more investors go in there. And when I talked about sort of marketing leading the naming of an ETF and the objective, obviously understand that, yeah, a lot of these thematic ETFs and even some of the factor ETFs are out there to attract investor money and looking at very hot sectors or sectors that have done very well. So just important to keep that in mind, right? If everybody thinks something's going to do well, whether that's AI or anything else that's been really popular lately, just realize that's priced in. Very high expectations are already priced into that ETF. And to actually have that turn out to be a good investment, what we need is for future results to exceed expectations. So that's an important point. I'll go through a couple more of these. Questions. My super fund is 100% Aussie shares. Is this basically the same thing as an index fund, given they own so many Aussie stocks? Yeah, so I think you put a good point in there, Michael. I don't know, because I obviously don't know what your super fund is or what it's invested in. It may be very similar to an index fund. It may not be. So if it's an active manager out there picking Aussie shares, then it could look very different from an index fund. So yeah, that's where you want to look at that portfolio and look at what the composition is. You compare that to the index. Craig has no sound. I'm sorry. I don't know how to fix that. So Alan says, after the RBA cut rates, what would be the impact to an ETF in general? All right, that's that's obviously a very broad question. What I would say is that when rates are actually cut, remember the market is forward looking. So it is anticipating at some point rate cuts. And we've seen a lot of movement about when that's going to happen. Every piece of data that comes out, people are trying to read, okay, when will a super fund or when will the RBA cut rates, or how long will they leave them the same? What I would say about rate cuts is the market obviously in general likes rate cuts, likes lower interest rate environments because that increases the valuation of shares. But when the RBA actually cuts rates, likely that is priced into the market unless it is a huge surprise. So yeah, generally lower rates are positive for shares. So yeah, that's the best I can answer that. What happens to franking credits in an ETF? They get distributed to you. So remember, an ETF or a fund are pass-through vehicles. So that means the vehicle itself passes through every bit of tax that you owe. It passes through all the income that's received from holdings within that, and it also passes through franking credits. So you will get franking credits if you are an Australian investing in an Australian ETF. All right, so here we go. We got through the preliminary questions. Okay, so we're going to use an example, and for people who have attended these before, I do like to bash this ETF a little bit, but I'll use it. It's not very well, but I'll use it as an example. So we're looking at the Global X FANG Plus ETF. So what I did is I just went to the page. I Googled it. I went to the page of the provider. So that's Global X, and looked at what they said about this ETF. So many investors, I think, as Daniel alluded to earlier, will look at performance and then they'll just read something very simple like that, and they'll decide if this ETF is right for them. So what does it say? Global X FANG Plus, and that's a ticker symbol, FANG, seeks to invest in companies at the leading edge of next generation technology that includes household names and newcomers. What does that mean? To me, if you actually analyze what that says, it says nothing, right? It's thrown in a couple words that sound great. Next generation technology. People think, wow, that must do very well. Household name. So, good stuff I've heard of is in there. And newcomers, whatever that means, maybe that means that people think there'll be new companies that will do very well. So what does it say in the objective? Well, very simply, this ETF tracks an index. So it doesn't really say much. So here it goes. It tracks the NYSE FANG Plus index. So the secret with an ETF is when they say it tracks an index, go look at the index. So that's the easiest way to get the information that we're going to go through today. So just look for whatever it says that index is, whether that's the ASX 200 or whether it's something completely different, and go in and look at that index. Because as I said, that index methodology is going to be the driver of what is in the ETF. And that's really important for you to understand how that ETF invests, even if it is passive. All right. So I went in and I copied some stuff from this ETF. And I'll kind of walk through what this means. Now, I do understand that a lot of these are not the easiest things to read. And yes, this can be very confusing for investors, but it is important to understand what's in there. And I think everyone can figure this out. It may take some Googling of different words. It may take a little thinking of it. Okay, so what are we looking at top line here? So we see the different indexes as part of the selection criteria that this ETF can invest in. So automatically, we understand that this ETF is buying US shares, right? Every single one of those indexes on there is a US index. So that's the first thing. Where does it invest? What country does it invest in? We see the US. Okay, here we have some criteria to be considered. And this is really, it says inclusion, but it's kind of also exclusion criteria. So the company market capitalization has to be at least 5 billion. So market capitalization is calculated by multiplying the number of shares outstanding by the share price. So when we talk about big companies or small companies, what we're talking about is that market capitalization. And when somebody says to you that Apple is worth $2 trillion or whatever it is, what that is that's the market capitalization. And when we say a company is worth that, means if I wanted to buy Apple, and for me to fully buy Apple, I need to buy every share out there. So that's why it's the total number of shares times the price. So I can go buy that whole company if I have a couple $1 trillion, which I don't, or I would not be sitting here. And actively trading for at least 60 calendar days. Okay, so we're not putting brand new IPOs into this. 60 calendar days, I would say, is not very long. But yeah, that's another criteria. Have an average daily traded volume of 50 million or greater. Now, the reason that a lot of ETFs include a average daily traded volume, so that's how many shares times the price are actually exchanged on a day. A lot of them have these liquidity measures in there, and they do that because, of course, the manager is trying to replicate how the index does. And if something is not traded very much, if it's a very thinly traded share, then it's hard to do that, because going in there and buying those shares will cause big swings in the price. So ETF managers want liquidity. So that's something that's in a lot of them. We already talked about the US. And then it's got all of these, and there's a list of them on here. It's got all of these sub-industry groups that a share is required to trade within in order to be eligible. And this is really when they have this term, if we go back a page, leading edge of next generation technology. What do they actually mean? It means that it is in one of these categories. All right, so you're not getting any oil companies in here. So at least you understand this is the universe that the ETF is evaluating for inclusion. So the very strange thing about this ETF that you will read as you go through here is that this is a tiny ETF, and I don't think I have the specific statement in here, but it's a tiny ETF. It only has 10 holdings in it. Now, we want to see how many holdings this ETF has, because a lot of the reason why we invest in ETFs, and we're told to invest in ETFs, is because apparently they're diverse, right? You get that diversification from just buying a single ETF. In this case, this is not an ETF that is very diverse. There's only 10 holdings in it. And so once you're putting together your portfolio, you need to think about that. How diversified is your overall portfolio? This is not very diverse. So what does this ETF have? Well, it has 6 securities in it. You see them all listed here. They're supposed to represent these FANG, and they're shortening it. This is just the first letter of all their name, right? So Facebook, Apple, Alphabet, Amazon, etc. So we see immediately that this ETF is already, of the 10 securities, 6 of them are set. So it's all these giant companies. Maybe you want to get exposure to them, maybe you don't. But in this ETF, 6 of them are getting included automatically. So there's a rule, and this is very unusual, but this is a rule in the index saying there's a certain amount of securities that are actually in there, and here are their names. Then we have to pick the other 4 securities. So we've got a couple criteria in here, and I'm not going to go through every single one of these. There are only 4, but basically what this ETF is, it is a momentum ETF at the end of the day. And, investing in a momentum strategy is something that people do. And basically what a momentum strategy says is that if something has gone up, it's going to keep going up. And you can see that because they're looking at 2 different things, that they're ranking all of the securities that meet that original criteria. The first thing is market capitalization, right? Bigger securities, how does a company grow? Well, or in market capitalization, well, the price goes up, right? Because we talked about how it's shares times price. So these are companies whose price has gone up. So they're big companies. That's 35% weight. 35% weight ADTV on the specific share class. Remember, we learned what that meant back here. Average daily traded value. Now, how much is traded every day really has nothing to do with the company at the end of the day. So it's investing in big, popular shares. So shares that investors are buying a lot, and it's ranking them. And then we have 15% weights on price to sales and sales growth. So no point during this are we talking about earnings. Obviously, we're really looking for, at the end of the day, kind of expensive tech shares that have done well. And that's the ETF. And you see down here, at quarterly index reconstitutions, each constituent is attributed a 10% weight in the index. So this is equal weighted. But in this case, because there's only 10 shares, we've got 10% weight for each one of them, and they rebalance this quarterly. Because obviously in between those quarterly rebalancing, we're going to have a lot of movement in security prices, especially because we're buying heavily traded shares that have gone up a lot in the past. And the reason we want to look at this rebalancing criteria is because, of course, that can have tax consequences for us. So Shares go up a lot in value and they need to rebalance by selling them off. They're going to sell off the ones that, of course, have done the best on a relative basis. So that can have very large tax consequences for you. The fact that they're actually doing this quarterly means that it's happening quite frequently. So this is just an example of digging through the information around an ETF to try to understand what it's doing. So we can at least step away and say the following things. It's invested in US shares. It's investing in technology or technology adjacent shares. 60% of the ETF is already set in terms of the companies that are in there. 60% of it is made up of these 6 companies listed right here. And that they're really looking at this momentum strategy to pick those other 4 securities that go in here, right? What are things that have done well in the past, in the recent past? So that's what they're doing. They're rebalancing this a lot. You're not going to have great tax consequences. So if you're kind of thinking, should I hold this in a super or outside of a super? Well, they're going to pay more taxes on this than you would as long as the markets continue to go up. So that at least gives us some clues, and that allows us to align that with our investment strategy. Remember, our investment strategy, we're looking at, okay, to accomplish my goal, what do I need to do? Well, if your goal is to invest in growth shares to try to get a very high return, then maybe this ETF is right for you. If your goal is to widely diversify your portfolio, well, we got to consider that when we put other ETFs in our portfolio. So yeah, just a couple things that we can learn from this ETF. I think we've got a couple. A couple more questions. The anonymous attendee said, for capital gains, do the ETF statements differentiate between greater than less than 12-month holding times, affecting whether individuals have a CGT discount? Yeah, I mean, they will. So all that will come through in terms of long terms and long-term and shorter terms. But if we think about that, if we think about the CGT discount, are you going to have one on this ETF? The answer is no, most likely not, right? Because they're quarterly rebalancing this thing. So it means pretty much every quarter they're selling things and buying things to get that equal weighted, to get it back into line with that equal weighted rule in this ETF. So those are going to be shorter term capital gains. So just something to remember. Somebody said, do ETF pay dividends 6 monthly? So I'd say, number one, remember they're distributions. They're not dividends, and that's nitpicky, but just remember that it does include capital gains. ETFs, different ETFs will have different rules. Generally, an ETF will pay quarterly. But yeah, there are different rules, but it'll say that there will be a distribution policy within the individual ETFs, and some pay more frequently than that. Some pay monthly. I will get back to that question. So let's now look at the portfolio. So this is an easy portfolio to look at because I don't need to look at the distribution between different countries because we know it's all US. We don't need to look at sector distribution because we kind of know what sector all of this stuff is in. And we can actually see all of the holdings very easily. So this is the ETF. So you can see that yeah, we're a little bit out of whack from a portfolio weight perspective. That will of course be rebalanced when we get back to the quarter, but we can see all the names. So does this ETF do what it says it does? Well, yeah, it does what it says it does. It's very simple. It's 10 different securities, but we can see these 4 securities that were not on that original list. So Snowflake, NVIDIA, Broadcom, and where am I missing one here? What was the other one? I think Netflix. Oh no, Tesla. All right. So at least we can see what's in this ETF. This is kind of a simplistic example, but let's go look at another one. We'll do one more example. And this one is VHY, so Vanguard High Yield. So this invests in, well, we can read what it says. So it invests in the summary description, low-cost exposure, and you can define if low cost is what you think it is based on the fee. Companies listed on the ASX that have higher forecast dividends, other ASX-listed companies, and they've got diversification rules in here. Now, we'll dig into some of the details on this, but there we see the index again. So what is this ETF tracking? It's a Vanguard product tracking FTSE Australian High Yield Index. So once again, now we know the index, so we can go explore what the index is. So I've taken the description that our analysts come up with, but it's basically the same thing as in the document. So we can start thinking about this. Okay, so what's it investing in? So mostly large cap companies with higher dividend forecasts among all the listed companies on the ASX. So we're going to take the Australian market and we're going to look at, okay, what are the dividend forecasts going forward? Now, this is an important distinction because a lot of dividend ETFs will look at the current yield. So for people that may not be familiar with some of these terms, when we look at a dividend yield, the way we come up with the dividend yield is we look at the dividend that's been paid over the past 12 months, and we divide that by the price. Now, the issue with using that is that, of course, it is backward looking. So what we care about as investors is, of course, what happens in the future. And the problem we run into when we're looking at past dividends and we're trying to find high dividends is that we can fall into dividend traps. And very simply, if we're looking at the last 12 months of the dividend and we're comparing that to the price, what happens if collectively investors decide that that dividend is completely unsustainable and that company's in trouble? Well, the price is going to go down, which actually makes the yield go up until that next dividend is declared. So that's the problem with using backward-looking dividend ETFs or using that as your own strategy if you're picking individual shares. So they are trying to get around that and avoid dividend traps with FHY by looking at forecast dividend yields. So what's it based on? 1 year consensus forecast dividend yields, right? Anytime you see consensus, what does this mean and who's doing the forecasting? Well, they're going out there and they're looking at analysts' opinion about what that yield will be going forward. So they're trying to eliminate those dividend traps, and they're trying to eliminate any company that might have a higher yield because a special dividend was paid. So special dividend could be paid if there were windfall profits. Special dividend could be paid if they sold part of the company and paid out a special dividend, but it's looking forward. So that's good. So it allows you to avoid those dividend traps. Does not necessarily mean that this consensus view that analysts have is necessarily perfectly correct, but it's still a good sign that we're forward looking. All right, so what are they doing? After screening the universe of the dividend expectations, the selected constituents are weighted according to their free float market cap. So what does that mean? Well, it means that they're looking at market cap in order to weight this ETF. So that means there is more of this ETF allocated to larger companies versus small companies. Now, most indexes are market cap weighted indexes. And I think a lot of investors have confusion about that, right? That if they go out there, like the ASX 200 is an example of a market cap weighted index. A lot of investors think, okay, I'm going out and I'm buying 200 shares. That's great. Look at how much I've diversified just by buying this one ETF. But if it's market cap weighted, more is going to go into the larger companies. Now, that can have a huge impact if the relative size between those companies and the index is fairly extreme, which it is on the ASX. I'll show you how you can find that later. That's why you want to look at the portfolio to see what is the ramification of this rule, this market cap. So for those of you who do know the ASX 200, BHP is by far the largest company that trades in Australia. So 10% of the ASX 200 is in BHP. Now, we don't know if BHP has been selected in this index. That's why we'll look at holdings later. But 10%, and even a little bit more than 10% of the ASX 200 goes into BHP. So just remember that around market cap weighted indexes. And there's a lot of arguments sometimes, I don't know about arguments, but a lot of people talk about, is it better to buy the ASX 200 or the ASX 300? People say, well, the 300 is a lot more diverse, right? It's got 100 extra constituents in it. But in reality, very little is allocated to that last 100 because most of the index goes into the larger shares. And the larger shares, of course, match, right? So the 200 largest companies in Australia and the 200 and the 300 largest 300, they're very, very similar ETFs. But at the very least, what we're saying is that this ETF, this Vanguard High Yield, is market cap weighted. So it's weighted similar to the market. And then we've got this line by our analysts. Thus, despite some sector skews, the portfolio carries a similar risk-reward profile as the broader market. So what does that mean? Well, sector skews, so it means some sectors, and we'll explore this, some sectors are a little bit different than the broader market, the ASX 200, right? But it generally aligns with it. So what we know then, or what we should know when we're valuing the portfolio, is the Aussie market is very, very skewed towards financials and miners, which fall in that basic materials sector. This ETF is going to be similar, right? It's putting more into the larger companies. It's obviously representative of the big companies in Australia, the banks, the miners. And so potentially what we're getting here, and we'll explore this more, but potentially what we're getting is something that looks pretty similar to the overall market, but is, of course, weighted and determined by that forward consensus dividend yield. So this should give us something that looks kind of similar to the current market from a sector perspective, but pays a higher dividend. That's what it should do. It pays a higher dividend going forward, of course. All right, so that's where it says the benchmark leans towards the highest dividend payers, excluding property trust. So a property trust is a REIT. Now, why is it excluding REITs? Well, one reason it's excluding REITs, and that's a real estate investment trust. So it's a company that owns property. Why is it excluding those? Because you don't get franking credits from REITs. So also very focused on franking credits, we can see that. So the index provider ranks all the dividend-paying stocks based on their dividend yield forecast for next year, and then constructs an index that makes up the top 50% of the float-adjusted market capitalization. So they are constructing this index based on large shares. And so they are putting the larger shares in there. So that's why this is a large cap, mostly large cap companies. And so once again, by weighting it that way, it's looking more like the market, although it's going to be more concentrated, right? Make up the top 50% of the float adjusted market capitalization. So they're not putting little shares in there, right? So they're looking at 50% of the highest shares and putting them in there. Industries are capped at 40%, individual stocks at 10%. So what does that mean? Well, it means that they have some diversification rules in there already. So if BHP all of a sudden became 20% of the Aussie index, it would not be 20% of this ETF. So they are trying to diversify this. Although I will say, looking at a specific industry or sector at 40%, an individual share at 10% is not that diversified. But at least there are some rules in there. So you're not going to get something where BHP makes up half the local market, it's half of this ETF. All right, so let's take a look at it. So I looked at two different categories for it. Why don't we start over here, the sector? And so really what we're looking at here, and we can see that the index is the S&P ASX 200 total return, Australian dollars. So we can compare this ETF to the index. And this just shows us where this ETF is potentially overweight or where it's potentially underweight. And the thing that obviously jumps out here, if you go down here, two different categories. One, financial services. So I said that the Australian market is very top heavy with miners, so that's basic materials, but it's about in line with the index. And financial services. You can see this ETF is even more weighted towards financial services. Why? Well, a lot of banks, for example, and financial services companies pay large dividends. And clearly they expect those large dividends to continue in the forecast. So very overweight financial services. We also see it very overweight energy. Now, one reason for that could be right now that, of course, with some of the turmoil going on in the world, a lot of people expect that oil prices and other energy prices will stay high. And so obviously they're forecasting high dividends going forward. Energy companies do tend to pay pretty high dividends when they make money. So when those commodity prices are high, as you can see, that's pretty big as well. Everything else is more or less roughly in line, but at least you understand now what's going on in this. And then we've got a bunch of different measures. And what we're looking at here is measures for the portfolio against the category average. So that's all of the Morningstar ETFs and funds that fall within that category. And that category is equity, Australia, large value. See that down there? And the index. So once again, we're looking at that S&P ASX 200 index. So we can also compare and see, especially with factor ETFs, when they're telling us they're going to do something, invest in value shares, invest in growth shares, et cetera. And in this case, dividends, we can see, okay, does this thing do what it says it does? Does it say what it does on the label? And really what we want to look at here is the dividend yield. Is this supposed to be a dividend ETF at the end of the day? Now remember, this dividend yield right here is a backward-looking yield. Now, they pick shares that go in there based on what they think they're going to pay in the future. Still backward looking, but you can see, hey, it does have a higher dividend yield than the overall index. So at the very least, from a historic basis, this is identifying shares that have paid high dividends in the future. And we've got that check in there to make sure that hopefully it is paying higher, these companies are paying higher dividends, not just in the past, but also the future. One thing to note, this dividend yield on here is not the yield you are going to get going forward. And that's true about any dividend. Anytime you look at a share's dividend yield, remember that's the past. We have to see what that company declares going forward. So we'll still have to see what that is, but at least this gives you a little bit of a view of sort of where it is right now. So, all right, that's our second ETF. We've got a couple questions. I want to keep pausing and doing these, but I'll stick around if people have some at the end. Okay, so we've got a question from Mark. I like your name, first of all. For the average Joe, or the average Mark, who doesn't have a lot of knowledge when it comes to investing, are the broad index ETFs, say one that tracks the S&P 500 and ASX 200, best for low risk and long-term growth, say over a 10 to 20-year period? Okay, so there's a fair amount of things to unpack in that question. So let me go through a couple. Obviously, listen, I don't know what's going to happen over the next 10 or 20 years. Clearly, I'm personally invested in the stock market. I do believe it will be attractive over the next 10 to 20 years. It depends what you define as low risk. There are lots of ways to think about risk. So it's a little bit of a hard question to answer, but yes, generally speaking, for someone who doesn't want to spend a lot of time buying individual shares or doesn't want to spend a lot of time looking at some of these factor or thematic ETFs and trying to figure out what's actually in that portfolio, yes, broadly diversifying in an index will give you the average return for the market. So remember, that's what an index, not these weird indexes we've been looking at right now, but that's what those broad-based indexes provide you. They provide you low-cost access to the average return. So yes, I think that is a really good strategy. So certainly not just me, obviously saying it. Warren Buffett has come out and said that most ETFs most investors should be passive index investors. So yes, things like that, ASX 200, S&P 500 are good bets. And really what we want to look at then is how can you put together your portfolio? Got a question. How can we access last week's webinar? I don't have a copy of it yet just because some people are out, but yeah, we should be making that available and you can email me for that. Although I don't have it right now, we'll also put it on YouTube. Okay, so we've got a question from Zara. If NAV is the underlying, and I'll define that in a second, it's the underlying asset value of the companies in the fund, why does it fluctuate, albeit marginally, with the price of the day? Wouldn't the value of the assets of the companies be the same? Okay, so first let's define this. So NAV is just net asset value. So I think what you're saying in this question is the value of the assets of a company. So the thing about the share market is every day we have changes in prices. Now, whether those are reflective of changes of the values of companies or not, there's a lot of different opinions on that. Probably not, right? Probably not. But really what happens is investors digest new data, or they're influenced by other things. They digest new data, and in theory, they then change the price in a rational way, although I think a lot of us don't think that that's actually true. But remember, the net asset value, the underlying asset value of the companies, is not the value of the actual value of that company or the value of the assets that company may hold. It is simply, when we talk about NAV, we're looking at the value of the shares, which fluctuate every day when the market's open, that are within that fund or ETF. So really what they're doing is they are tracking just the value of the shares. That BHP goes up 10%, well, it's going to go up. Is BHP worth 10% more? No. Yes, maybe. Are the assets that BHP actually owns worth 10% or more every single day? No. Absolutely not. Just remember, it's the change of the value of the constituents in there, which are the things that are traded on the share market. So hopefully that answered your question. I think I understood it. Looks like some people are answering other questions. Okay, so hopefully I answered. Sue says, could you speak about the historical earnings percentage? So I don't exactly know what you mean by historical earnings. Oh, you're probably talking about something that's on that chart. So what am I looking at here? Honestly, I don't know what that means. So I will admit that. I will go back and check that. Maybe Sue, if you email me, I will look that up. Historical earnings percentage. Historical earnings percentage. Yeah. Apologies. I do not actually know what that means. I should not be putting stuff up here that I don't know, but I've obviously just copied it. A couple more questions, and we'll talk about portfolios. Is the allocation versus index weighting and the measures evaluation you've shown publicly available somewhere? Does ETF publish this? Yeah. So the data that I'm getting on here is from morningstar.com.au. It's also available on Investor for any of our paid subscribers. It's also available on the ETF provider website. So if you go on to that ETF, they might not have every single measure I have on here, but if you want to look at the portfolio composition in terms of countries, in terms of sectors, things like that, like we have on here, that's all available on the ETF provider website as well. So you can go look at it there, or you can come to morningstar.com.au, type in the ticker for the ETF, you'll get a quote page, and then you'll see a little sub-tab that says portfolio. It has a bunch of different measures. Maybe I'll show that at the end. All right, so let's talk about portfolios. Building an ETF portfolio. I probably should have made this type bigger, but anyway, all right. Building a portfolio out of an ETF is no different than using any other financial product. So using a fund, for example, or individual securities, right? It's the same process. We want to focus on the same process. And really what we're looking at is we want that alignment with our goals and strategy. And we want to make sure it's diversified. So we're really not doing anything different with an ETF. But the important thing to remember is that when you are using an ETF or a fund, what matters let me get into this on the second point. What matters is not how many ETFs you hold. What matters are what those ETFs hold within them. So remember that what you're investing in is not the ETF. That is a wrapper, right? What you're investing in and what will determine if that investment goes up or down or doesn't move is what is held within that ETF. A lot of people talk about ETFs like they are what you're investing in. Well, that's not true. You're investing in, right, once again, the constituents in that ETF. That's why we want to spend so much time looking at what is the criteria to pick securities that go into that ETF. So there is no right number of ETFs that should be in a portfolio. I think people get a little confused about this. And they're like, oh, well, I need to diversify my portfolio. I need to have 15, 20 ETFs in there. Well, no, that's not true. You can have a very diversified portfolio by investing in one ETF. What we really want to focus on, and there are advantages to simplicity, right? We do write a couple of articles. Shani and I did a podcast on this. My colleague James wrote an article on a 3 ETF portfolio recently. There are a lot of advantages to simplicity. And really the primary example is the primary advantage is that it's a lot easier for you as an investor to keep track of your portfolio and what's going on if it's a very simple portfolio. So remember that. Most ETFs are already diversified. So really what we want to focus on, you want to have a reason and a real reason. You want to have a reason that you are going and buying each one of these ETFs. So we want to be very, very careful with things like overlap and the impact of market cap weighted indices. So I'll talk about both of those. Overlap is that a lot of people who are buying ETFs, seemingly from things that I read, are going out there and kind of picking off a couple things that sort of sound good, right? From a naming convention perspective, from a marketing perspective, going and just grabbing a couple things that's, oh, technology sounds good, I'll grab that. Oh, like somebody told me that I should invest globally, so I'll grab this ETF. And it's really important to understand that there's a lot of overlap between a lot of these ETFs to the point where you're really not adding much value by adding these to a portfolio. And so I can come up with a couple of different examples. You know, people might sit there and well, we have some examples. So we'll go through those examples. The other thing we have to look at is the impact of this market cap weighted index. What it means is that if you're buying a bunch of market cap weighted indexes, global ones and local ones and everything else, just remember that a disproportionate part of your return will come from those larger shares. Now that is either a good or bad thing, but it's just something to realize when you're going in there. Yeah, Dan has a good comment. So right now, what has done well? So what has done well since the global financial crisis? Australia is a little bit different, right? So Australia doesn't really look like the rest of the world with sort of being overweight in banking and mining, et cetera. But what has done well globally has really been large U.S. tech shares. So back to kind of 2008 when we came out of the GFC, because they have done very well, they make up a disproportionate amount of a lot of indexes. So US tech shares in the US market have done well. So if we look at global indexes, the US makes up a huge amount of those indexes. When we start to get into the US and we start looking at different indices in the US, the S&P 500 is very different than the NASDAQ in terms of the way that those indexes and the ETFs tracking that are put together. The S&P 500 is the 500 largest companies in the US. Doesn't matter what exchange they trade on. The NASDAQ is an exchange, right? Like the New York Stock Exchange is an exchange. NASDAQ is an exchange that a lot of technology companies list on. So if technology companies have done very well, if they're both market cap weighted, what does that mean? It means all the names, a lot of the names are the same. Same thing with the FANG that I just said. Those companies that have done well, Amazon, Facebook, or Meta, Netflix, Tesla, all these companies that have done very well make up more and more of the index. global markets, US markets make up more and more of the index. And that's where we have to start looking at that overlap, right? So when people say, okay, I'm going to buy the S&P 500, but I'm also going to buy the NASDAQ because I'm really interested in technology, all the same names are at the top, right? Google, all those names that we hear all the time, they're at the top of a lot of those indexes. And that's where you're getting a lot of the overlap. So what you should think about is each ETF that is purchased should have a specific purpose that it serves in your portfolio, and a real purpose, as I said before, not off of just the naming convention of that ETF. We want a real purpose. So I'll quickly go through a couple examples. Now, I'm using something that's actually only available to our professional clients, but I just want to show some examples of the ways that people might construct portfolios and things they should think about. All right, so the portfolio, 75% Vanguard Australian shares. That's the ASX 300. 25%, that ETF we just went through, Vanguard High Yield. Now, remember, we saw those rules of Vanguard High Yield. So what is this telling us? Well, here are the two ETFs. What's the correlation between these in terms of their performance? 97%. So is this portfolio providing you with a lot of diversification? No, it's not. So this is an example where, because they're both dominated by the same names, you're getting a lot of correlation. So should you add these both to your portfolio? I mean, maybe you can. Now, remember, if you're looking for dividends, you're going to get a higher dividend yield from VHY. But if you're just looking to go out there and trying to get exposure to the Aussie market, you're just think, oh, well, I'll have a little bit of a tilt towards dividends. Maybe make a decision between one or the two, right? Because you're going to get very similar returns. You'll just get higher dividend yield. Is that actually important to you? So there's an example. So IVV, that tracks the S&P 500 and NASDAQ. So in this case, the correlation is lower, so 0.67. But at the same time, remember, there is a lot of overlap between these as well. But perhaps this actually is a driver because it's 0.67. You have to make your own decision on that correlation. But yeah, a lot of these giant NASDAQ names, a lot of these large technology names are also in the S&P 500. So they're represented in both indexes. VGS. So VGS is a Vanguard product that covers developed markets globally. And once again, IVV, so that US S&P 500, pretty high correlation as well. Why? Because the US market has done very well. US market makes up something like 70% of global indexes. And this is, once again, where you have to look at what's in there, because you might say, okay, I want to own the whole world. You read the literature, invest in 22 different countries or however many developed market countries there are, and you think, well, that's great. Like, I get diversified around the world. You look at all the names. Oh, they've got the UK and Japan, and you're going through all these little European countries that are in the developed world. Well, 70% of your index is in the US. So it's important to look at it, right? Don't just read that marketing material. Look at what's actually in there. So the implications of market cap weighting is it's very tilted towards the US. So it can be very similar to going out there and buying just the US. And I'm not saying one of these is right or wrong, but it's important to understand what's in there. All right, so we're just hitting time. I'll answer a couple other questions that we have in here. Okay, so we've got a question about LICs versus ETFs. So let me quickly, and sorry for coughing so much. Let me quickly answer this. I see we've got some opinions in here. Okay, a LIC is very, very different than an ETF. An ETF, in theory, and in practice, very, very close to this, will track the index that it is assigned. So basically, there's a very small, for all practical purposes, there is no difference between the value of the underlying shares that are held in that index and that ETF. A LIC is what's called a closed-end fund, which I saw somebody put in there. Closed-end fund means that the price of that LIC is determined by supply and demand. So there can be large differences between the price of the underlying assets in that LIC, so the shares that it holds or the bonds that it holds or whatever else is in there, very big difference between that and what that LIC is actually trading for. Right now, a lot of them are trading at large discounts. Some people like that, but of course that discount may never go away. That's one difference. The other difference is around dividends and capital gains. A LIC is not a pass-through vehicle. So the manager decides when those dividends and capital gains are distributed to you. So when you get money in your account, when you have to pay taxes on it. And a lot of LICs try to smooth out income. So they'll keep a reserve so that if a bunch of dividends drop in the holdings, they've got some reserve that they can pay out for you. And they're trying to appeal to people who like that, who like smooth and consistent income. So that's the primary difference. Let's see, what else do we have? And LICs, and I will say, LICs are always actively managed. So if you're asking me my specific preference, I don't love actively managed products. So I'd buy a passive ETF or a factor ETF. That's personal. But remember, while there can be actively managed ETFs and there are actively managed ETFs, most track an index. In LIC world, they're all active. So Lynn's saying any difference between buying through an electronic broker like NavTrade or going to the issuer or Vanguard direct? There could be differences in what you'll pay to trade, but really there's no other differences. You're owning the exact same asset. I wouldn't worry about that. How much currency hedging should be applied? So one thing about ETFs is, Daniel says it also availability, right? What you want to invest in. But if you're going to buy Vanguard Australian shares directly from Vanguard's platform or from NavTrade, there's no real difference other than, of course, what you're paying for that fee. We've got a currency hedging question. There are a lot of products that have a currency hedging component to it. And basically what that means is they are removing the impact of currency fluctuations on your returns. So how much should be applied in a portfolio? Listen, it's up to you at the end of the day. So what I think it is it's thinking about what impact would currency have potentially on your life. So the example I always use is that what we want as Australian investors when we're buying overseas shares, we want the Australian dollar to go down. The Australian dollar goes down against, let's say you're investing in the US, it goes down against the US dollar, then that adds to your returns. So we want a really weak Australian dollar, and we want it to keep dropping because that adds to our returns. If you travel a lot, say you travel a lot to the US, the Australian dollar going down is really bad for you, right? Because everything's more expensive in the US. So that could be a situation where you'd say, okay, I want an unhedged portfolio because at least they balance each other out. I'm getting more returns, but when I go to New York, a cup of coffee is $15. Maybe you can live with that. If you're a very long-term investor, it's very hard to predict where currency will go. So it's harder to kind of play that in terms of where currencies go than it is to think about your life and kind of hedging your life a little bit if you travel a lot overseas. Is listed property the same as REITs? Yeah, it is. The exact same thing. And they're sort of used interchangeably. What's better, direct index funds or ETFs? Well, it depends. So when you're talking about an index fund, which is how this starts, you're talking about a managed fund. It all depends upon access. So one of the advantages of managed funds that I think people don't think about a lot is that while it is very difficult to access a managed fund in Australia, once you have that set up, you are not paying all those trading costs. You're not paying any trading costs. So if you invest in a managed fund, which may have a higher minimum, maybe a pain to set up, so you have to fill out a bunch of paperwork, You can put in regular deposits generally that are a lot smaller, and you don't pay a trading fee for that. So that can be an advantage. But a managed fund and an ETF, they're tracking the same index. Depending upon what the fee is on each one of them, you'll get the same return. The other advantage of ETFs is you can trade them during the day, where funds you have to say, I want to sell this, and you wait for the end of the day to see the price, and that's how much money you're going to get back. So you can trade ETFs intraday, which I know people in theory like. It's the best decision in the world. It adds some behavioral risk. But yeah, eventually the returns minus the fees will be basically the same. Okay, yeah, one thing, Daniel. So when he was talking about a managed fund, he's talking about an index managed fund, right? So there are managed funds that are passively managed to track an index. So they will be literally tracking the same index. You have an ASX 200 managed fund or an ETF, they'll be tracking the same index. If there's a change in that ASX 200, they'll both have to make those trades. So yeah, we're talking about a very, very specific part of managed funds. Let's see, we got a couple more questions. Okay, what is your opinion on equal weighted shares in ETFs? Would you use them? Yeah, I would and I do. So I happen to own, instead of owning a ASX 200, I own an equal weighted Australian index. So what that means is we've talked a lot about market cap and how a lot of the indexes out there, when somebody tells you the ASX 200 is up this much or down this much in a given day, that's that market cap weighted index. That's what a lot of those ETFs actually track. An equal weighted index will put an equal amount in every single one of them. The disadvantage of those are that they're going to rebalance. Whereas a large, broad index changes very infrequently and really changes on the margins, right? Maybe the 200 largest share becomes the 201st and something overtakes that. It's a very small position. You're not getting a lot of tax. So the real disadvantage of an equal weighted ETF is that they're going to rebalance and that could have tax consequences. The advantage is that you are not, you don't have such a sector and individual security skew, right? So if you think the average company trading on the ASX is going to do better than BHP, CSL, the banks, all the things that are kind of dominating the index. So yes, I do use those products, but people need to decide that. How can you assess if an ETF is overvalued? All right, it's very, very difficult. So good question, Colin. So basically what you would have to do is you would have to have a view on the valuation of every single constituent in that ETF, and then you'd have to weight it in the way that the ETF is to come up with a price to fair value for that ETF. So it is very difficult. So what people would generally use when assessing valuation on an ETF is they use measures like we're on there, the price to earnings ratio, those relative valuation measures. So what we need to do to see if that's a good or bad number is we would look historically. But remember, the tricky part about that is, so you could say the ETF is trading at 16 times earnings, but for the past 15 years, it's traded at over 25 times earnings. I think it's cheap. But remember, you do have to figure out, is it trading at a lower valuation for a reason? Right? Because remember, the market's forward-looking. It's all expectations. Price earnings can come down if the market, for example, thinks there's going to be a horrible recession and earnings are going to fall for all those companies. So all of a sudden it'll go back up, right, when those earnings fall. So you do have to have an opinion. But yeah, it's tricky to figure out if an ETF is undervalued or not undervalued. Just like if I went to you and said, is the market undervalued or overvalued? Whatever that opinion is would apply to an ETF tracking that. God, I'm coughing a lot today. I think Do you recommend a hedging strategy for AXX core ETFs such as IOZ using derivatives like put options if you think the ASX is about to go down? I mean, my question would be, how do you know it's going to go down? So what you're not really hedging, I guess you are taking, I guess technically you're hedging your portfolio. If you're sure it's going to go down, then yeah, why not? But yeah, I guess good luck trying to figure that out. Would the Shiller P of that country's index help? I was looking at India's index and the ETF index. Yeah, I mean the Shiller. Remember that the Shiller P once again. So that is using what it's trying to do is smooth out just fluctuations in earnings based on the business cycle. So what we're looking at really, so what it is it's a CAPE ratio, so cyclically adjusted PE. Remember, it's still a relative valuation metric. So what you have to do is look at that Shiller CAPE, compare it to something else to make a determination historically, to make a determination where you can say, okay, and in the case of India, you could say, all right, the Indian market is trading at a higher valuation than it has historically. But you also have to have a view that it shouldn't, right? Because if all the Indian companies that make up that index are expected to grow really quickly, they're supposed to grow their earnings really quickly, and all of a sudden that market will actually be cheap. The price doesn't change, right? That P ratio will come down naturally if the earnings go up. So just remember that what you want to look at when you're looking at a relative valuation measure is you want to know what it is, and then you want to figure out why. Why does the market think that something should be valued historically over or undervalued, right? For years, we sat there and we looked at all of those price earnings ratios. And yeah, we could go back and look at what the Shiller PE is back to, I think he has it back to the late 1800s, at least in the US. And we can say, oh, the market's expensive. But the question is the environment different? Like, are interest rates lower than they used to be? More people interested in stocks than back in the late 1800s. So just remember, you have to have an opinion as well. Glass of water needed. Yeah, a couple things needed, Doug, but we'll stick with water. Daniel loves ETFs. He seemed to be mostly comments. So Craig says, are you able to invest in an ETF for your grandchildren? Are there tax consequences? I've got a great article that Shani wrote that I can send you talking about the different ways that you can invest for your grandchildren. So I'm assuming they are under 18 at this point, but send me an email, Craig. I'll send you that article by Shani, which really talks through the different approaches that Daniel says it's awesome. Yeah, I didn't write it though, so I'm not taking credit for it. Shani wrote it. But yeah, that's oh, and Rod, I've got a good question about where I've got a good article that Shani also wrote. So just plugging Shani. The issues with where ETFs are domiciled. So now because you can trade just a little bit of a preview. Now, because of course you can trade in the US pretty easily, you can buy US domiciled ETFs. There are some complications with doing that. So the article kind of goes through what those are. It kind of depends what you're investing in. There can be weird relationships, and there's some tax consequences, which the article goes through. But there can also be some weird currency relationships. If you are going to the US to buy a Malaysian ETF, so an ETF that invests in Malaysia, all of a sudden you just have to think a little bit of a triangle, right? Because currency goes from Malaysia to the US to Australia. And basically, the thing that could throw you off is if relative the US dollar appreciates against the Malaysian ringgit, right? And the Australian dollar depreciates against the US. Like there could be some weird triangular issues, but really it's basically around tax. And I can send you that article. All right. So I think we made it. Okay. I think we made it. So anyway, thank you guys very much for joining. Obviously, shoot me an email, mark.lamonica1@morningstar.com if you have any questions. Next week, we'll talk about passive income, which is fun. But yeah, hope everyone had a good time. And yeah, Daniel, I think you win participant of the day. Not that everyone else did not also do well, but a lot of comments from Daniel, so thank you. Anyway, hope everyone has a good night. I'll go get a glass of water or something else. Talk to you all next week.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.